Hey everyone, you're watching News of the Money World. In this episode today, we're covering GDP number announcement on Wednesday. We're talking about, is Apple the new Coca-Cola or Nvidia? We're going to be exploring a little bit around debt and what is it telling us at the moment. And if we get there, we'll talk a little bit about crypto inflows or Bitcoin inflows specifically. So how are you doing there, Rupert?
Oh, very good. It's been a bit of we're here. That's
We're
all
here.
that matters.
That's right. After like 20 attempts to get rolling, we're here. So let's get stuck into the first one. On Wednesday, we have an announcement around GDP figures coming out. And like a lot of these data points, CPI would be one of them. They are useful, but you kind of have to understand some of the nuances within them. The more I am learning around GDP in particular, this is the case. So I don't know where our audience is at with GDP before. So for just a reminder, I wrote down some of the key things that GDP or gross domestic product tells us about the change, or like what the change is saying. It means that it's like an indicator of how well the performance of the economy is doing or how poorly it is doing, if it's positive or negative. It can tell us a little bit about the standard of living, because if we're really, really productive, we're unlocking a lot of wealth, and that gets sloshed around. Well, hopefully it gets sloshed around the economy. It tells us a little bit about the business cycle. It helps us to have a comparison tool around other countries, and it gives us a bit of a clue as to the impact that government policy is making. So, Rupert, Wednesday, your thoughts? It's been pretty flat and a little bit negative in terms of growth. What are you thinking is it's going to tell us?
Look, I think it's going to be pretty depressing. So at best, it might be flat. I suspect it's probably going to be a little bit more negative than that, though. So indicating that we are in recession. Look, I think the banks are pretty. There's a couple saying slight recession, a couple of saying slight positive. No one's really too sure. What they are all pretty consistent on, though, is that we are likely to be on a per capita basis negative. Okay. And so the truth is, we've had about 3% population growth over the last 12 months. And so that means that even the total GDP will be flat, but on a per capita basis, we're looking at -2 to -3 over that period. And that's pretty bad, right? That's as bad as it got during the great financial crisis, the GFC, back in 2007, 2008. So it's a really interesting one right now. I think a lot of people, depending on what you want to look at, right? If you're a past politician, you might look at the total number. But I think it comes back to New Zealanders at the moment are doing it tough. They're feeling really hard about things. And I think this is where one of the things we talked about last week is pretty interesting, because people are finding it tough. People are going to get unhappy. They're going to start moaning pretty hard. Inflation is still not under control. And how much longer do the politicians let this go? Until kind of we start to see some kind of movement at the Reserve Bank level, because you can easily see another 6 months of negative GDP on a per capita basis, or pretty strong negative GDP on a per capita basis, with interest rates not moving. And that's not very nice if you are the politician that's probably going to get blamed for it.
You want to break down the impact that immigration has, just because I don't want that to be lost, because immigration is so high, the denominator is higher. And if GDP is already kind of weak in terms of the overall output, then that implies that it's just distorting the figures, isn't it? So we're not really getting a clear picture because of the rate of immigration in the last little while.
Oh, 100%. To be fair, though, that's been the path of New Zealand for the better part of the last 15 years, right? Where we're using immigration has been a great way for us to boost our GDP numbers. New Zealand's rockstar economy back in kind of 2011, 2012, that was really an economy based on immigration and intensification of dairy. Not exactly great productivity boosters, but it gave us some amazing headline numbers that made us look really rich.
Yeah, and when you look, when I was doing a little bit of research around this, I was looking at some graphs that showed the contributors towards GDP, and you could see that, right up there in terms of contributor to GDP is actually looks like the government or public sector. So you can't really just spend money on management and expect that that's going to increase productivity. And when you look at the actual supply or the amount of extra production going on with goods and services, that's incredibly weak. And I guess we need a lot of people coming into the country in order to justify the spend on infrastructure that we need in order to take our country where we need it to be. But what you're implying is that immigration has kind of been used by the politicians to goose the numbers to kind of make it look good the easy way, right?
Oh, massively. And it's been done for the last 15 years where we've used immigration has been a great way for us to kind of to jump these numbers. And so, look, I'm curious to see where it's coming. I think it also shows the real challenge that we have as a country.
Yes.
I mean, we're not talking about a problem that we've had for the last 10 years or the last 5 years. We're talking about a problem that's been going on for the last 25 to 30 years of low productivity. And these numbers that we have at the moment are really kind of going to bring it all to the front. And it's going to be pretty hard, right? I mean, I listened this morning on the radio to a whole lot of politicians talking about how their policies are going to mean a massive quick jumps in productivity. But it'll be interesting to see whether that happens or whether they just continue to pull the immigration lever because it's a much easier one to pull.
Yeah, and how hard will they pull it, and what other side effects will that have? And it's kind of like, I guess, you have two bickering people, and there's a flare up over one issue, but really they touch on past issues and magnify it. That's kind of like what the left and right does. And there's this issue really that has been around for so long. Like when you look at the graph since 1971, funnily enough, everything seems to go out of kilter from 1971. GDP goes up, but the volatility is increasing as time goes on. So it will probably become a harder problem to solve. And that kind of flows into one of the things that we'll talk about later on around mortgage rates, because the Reserve Bank is really now properly in between a rock and a hard place. If they raise, it's really going to be harder and harder and harder on top of what's already hard, right? But if they lower it, it's going to create another problem potentially. So we'll come back to that in a second. If we can, let us talk about Apple, okay? Because you have a really interesting take on this, and I'm curious to hear more about this in terms of what you think Apple is like. And what kicked this off is an article that you shared with me around in a Bloomberg article where it implied that Apple could be the new Coca-Cola. And for a definition, you have growth stocks, value stocks, and I guess for a while, a lot of these tech companies have really been the epitome of growth stocks, going from strength to strength. And with AI supercharging it recently, we've seen that just go to the next level. But at some stage, you'd expect that the rate of growth would ease off and it would find a natural point of equilibrium. Apple is unique. It's a technology company, but it's also a hardware company. Is it software? Is it hardware? So is it NVIDIA or is it Coca-Cola? Obviously, Coca-Cola is not really going to implement AI and have a boost to earnings, is it? Because it's a long-established player. So you have an interesting take on this, in that it's neither NVIDIA or it's Coca-Cola. Do you want to take it from there?
Well, yeah, I'm kind of curious, right? I mean, and I've got this very wrong. For the last probably better part of the last 10 years, I've been slightly skeptical, thinking it is simply a phone manufacturer. It is a maker of phones. And let's be honest, you say what you want, that is still where 70% of Apple's revenues come from. And at what point does that change? And at what point do we kind of recognize that and think about Apple slightly differently? I mean, it's kind of, when I look at the previous 5 years, I'm just looking down at my screen, they've only grown, their revenue base has actually only grown at 7.6% per annum.
Okay.
Their 2024 revenue is expected to be lower than where they were in September 2022. Yeah. And so you've kind of got a company that's kind of flatlining, solid install base. They've managed to build a great ecosystem. But yeah, is it a high growth company? Is it something that kind of, or is it just a steady state player now, right? And that's the gazillion-dollar question that I don't think anyone gets their heads around. That's currently trading at a 25 times PE. You compare that to a market average of about 18 times PE. But yeah, I just kind of wonder, is that too high or not? And that kind of makes me think, actually, what is an appropriate set of comps for this business? Is it Coca-Cola? Maybe. Probably a lot of the American, when they think about these safe, steady, iconic brands, sure. Or is it Samsung, who takes the other kind of 40, 50% market share of high-end smartphones? And that's the bit that I kind of can't quite get my head around is what are we looking at here? Are we looking at a Sony, a Samsung, or exactly what is this business? And I think it's a really big question that investors need to start asking. I'd actually argue Tesla, we should be asking exactly the same set of questions as well. I mean, how is it that Tesla is valued at more than the next 3 car companies combined, when effectively it's a car company that makes a hell of a lot less than everyone else. So, yeah, I think I'm kind of curious to see how some of this stands out and where it goes, because I also find it really hard to see how AI changes and transforms the valuation of Apple.
Okay. Yeah. I've nothing to add really, apart from I get what you're saying, and I think the market will always look at things for as what, in terms of what they're like, rather than as the market is. Or if let's
Yep.
keep it simple, right? Like when you're looking at, say, Tesla or Apple, you'll naturally try to come to the table with comparisons of what you know, and therefore what would be your reasonable PE for that company based on what they do. But yeah, why can't they do more than one thing really, really well? Why can't they be really good at software and hardware? And like, we know that they're willing to change their mind on the hardware piece, as we've seen with canceling the EV. So I don't know. Maybe we just need to be having an open mind and maybe allow there to be a third category, like a value growth. I don't know.
Well, but we would like it. But the problem is we're giving it credit for that today.
Yeah, right.
So we're already giving it credit for that extra growth. And if you think about it, I mean, yeah, don't get me wrong, the iPhone is an amazing product. But before that, so was the BlackBerry, so was the Nokia 8810. It's not exactly as though there are a whole lot of other phones that haven't been knocked off the perch in the past. And I think we just need to be mindful of the fact that Apple, that its entire ecosystem revolves around that iPhone. And yeah, I do kind of find it curious as to how long does that last for.
Yeah, right. That moat has a finite lifespan, is what you're wondering. It is
A little
already
bit like the Facebook moat that we thought was existing, and kind of we thought Facebook was impenetrable and was going to be there forever. But now we know most young people would much prefer TikTok to Facebook. I mean, what's the iPhone equivalent that's going to turn up?
Yeah, we won't know really, but it'll probably something to do with glasses, I'm going to guess. And maybe not, right? And I guess it's underperforming the NASDAQ 100. So maybe, I guess, as it gets kicked out, it could get worse. Like, is that the thinking? Like,
it's still got a long way to go before that. I mean, it's still the second largest company in the world. And so it will be there. The problem is with companies like this, often it takes 1 or 2 missed earnings, and then the tide very quickly turns.
Okay.
And all of a sudden we go, actually, the moment the narrative shifts, and rather than it being a tech company, it becomes the next Samsung. So putting it in relevant metrics, I mean, Apple at a 25.3 times PE, that compares to Samsung at a 15.1 times PE. It's a big difference in valuation, right? And so that's the bit that I'm kind of, it won't take a huge amount for that to be the answer as well.
Okay. Well, they're promising big things to be unveiled in a few months in their annual conference, I guess. So I guess we'll see, right? We'll see if they can pull it out of the hat. All right. Well, let's talk a little bit about debt, because this is the thing I think that ultimately hits home. Literally, it hits home, and it can hit us in our homes and hit ourselves out of our home too, if we're not really careful about it, right? Like our mortgages are becoming more expensive here in New Zealand. We're a little bit more sensitive to interest rate rises because we tend to fix for 1 or 2 years. Talk about maybe being a little bit more clever than that, but we really always go for 1 or 2 years. And so we get impacted a lot quicker than what might happen in the United States, where they'll have 30-year fixed rate mortgages. And so often there's a huge portion of the population that aren't affected by mortgage rates. And so when you're trying to understand what the data is telling us, like here in New Zealand, we have 500,000 Kiwis that are behind in their loan repayments. That is massive. That came out of some Centrix data a couple of weeks ago here. In the US, we probably have a richer bit of data that we could draw upon, because their personal loans, student loans, consumer loans, probably a much bigger market. And we can see that that's starting to become a massive burden. So yeah, like I have so much to say around this that I'll just start by hearing you. So what do you like? I'm looking at this Bloomberg article that says American debt stings like never before in a new era of households for a household. So what are your thoughts?
Well, I think there's a couple of things, right? I think people have taken on a huge amount of debt over the last 15 years. There's no question on it, on the basis of the expectation that that interest rates stay low. And now with interest rates not coming up, you've just seen this massive spike in those interest payments. And actually, it's the first time ever since records began that non-mortgage payments will be lower, than the personal debt payments as well. So it kind of really has gone through a big area. So I think it does portend a little bit to the pain that consumers are about to feel with these higher interest rates and are currently feeling. The second thing that the data shows is it was just this massive spike in personal debt over the last 2 years. And so we've seen debt grow at a faster rate than, again, over the last 2 years than any time in history. And I think what that really does show is that higher interest rates, the inflation, is starting to bite. And to me, it raises some real questions around actually how much longer is this American consumer going to be able to keep on spending for? Because, and let's be honest, without the American consumer, the global economy would be in a much sicker place. It's the American consumer that's keeping us all afloat right now.
That's a really important point, because that is the fundamental basis for how most policy is designed. It's based on consumption.
Yep.
And so as soon as that consumption starts to fall away, the rest of that pyramid can really break down quickly. But what you were saying around the personal debt increasing is interesting as well, and because it's kind of like a picture of what's happening, probably, again, more so in the US, where they're almost $35 trillion in public debt right now.
Yep.
And interest costs is becoming, or will become, one of the biggest line items soon, so that pretty much tax is servicing just the interest payments on debt alone. And if you think about that at household level, at a certain stage, when you can't afford to reduce your principal, the amount outstanding to the bank, that's one thing. But when you can't afford to service even just the interest payments, then your days are kind of numbered as to how long you'll own that asset, and you're going to have to let go of it. Now, if that's something that's happening with not every other household, but with enough households around you, if that happens with enough of the governments of the world as well, then we have a real problem with debt, where there does need to be some sort of a reset scenario. It's something that we covered on the podcast, on my podcast, The Everyday Investor, recently. And I found that quite an interesting discussion to get into, because it felt a lot like a conspiracy theory, talking about how currency would eventually need to reset in order for this to all kind of be put back into order. Your thoughts, though, around, say, a currency reset just to wipe away the debt and start fresh again? Do you think that that's something that we would ever see?
Well, to be fair, we saw at Bretton Woods in the 1960s that was one of the things they used to deal with the World War II debt. I think it's going to be pretty hard to see that happen. I think, look, it's a massive question that none of us really know the answer to, right? I mean, unfortunately, and I remember you and I did an episode on this, 3 years ago, actually.
Good memory.
The easiest way to deal with debt is inflation.
Yeah.
And so that is kind of one of the reasons why I think, again, coming back to my point on the politicians, right? Lower interest rates, higher inflation, but you've got people that kind of feel as though they've been given a little bit of room. You run a 4 or 5% inflation rate for 4 or 5 years. That's a massive way to deal with your debt burden. Yeah. But I kind of, I'm very, very curious to see where and how it all goes, right? Because we have seen over the last 12 months what we saw in the UK with Trussonomics, which got quickly rejected by the markets, and her ejected as Prime Minister in the UK. But we haven't really seen too many other kind of countries be hauled up for their debt. I mean, you look at Japan, right? 200% of GDP. But again, the difference there, I think, is that they've got a much stronger household set of balance sheets. So they can fund a lot more of that domestically than many of these other countries. But yeah, I mean, what happens to the US? What happens to them when they've got 120% of GDP and finally everything rolls over and they're funding at 5.5%? That means that 5-6% of GDP is going every year into debt payments for a country that only taxes at 24. Yeah, that's a pretty difficult set of maths, right?
Yeah. Well, all I can hear in my head is, I'm giving it all she can, Captain. The voice of Scotty, operating at warp speed, going as fast as they possibly can and approaching hyperinflation where they lose all control, but they have to bring it right to the limit in terms of what the economy can handle, because that's the only way that they're going to get out of this, is by speed and by just racing away from this explosion that they themselves have caused, of course. But yeah, I don't know. I'd love to see things go through and just eventually reach a new normal. But increasingly, yeah, it does kind of feel like the whole world is racing towards some sort of event where we're going to just have to be comfortable with a little bit of reorganization. And I don't think it needs to be a scary thing. I just think it needs to be something that we prepare for, or not. Like maybe it doesn't happen, but I think it's kind of wise. So, like now we're thinking though around. I just totally lost my train of thought now that I was thinking about the world exploding. Um,
That's just it's your typical. This is your typical segue into Bitcoin.
Oh, that's right. That's right.
Because I mean, how can you forget this one? This is so we sit there.
So if you can fix the money, you can fix the world. Now that's a slightly idealistic statement to throw out there when we're talking about the mess that the world is in. But like a lot of people do genuinely believe this, right? And I think that as the enthusiasm towards Bitcoin catches on, I think a lot more investors are going to gravitate towards these exchange traded funds, these ETFs, and we're going to see inflows crank up like massively. We had the Binance CEO recently come out and say that they would see $80,000 per Bitcoin, US dollars, just based on the ETF reality alone. Now, I think that's way undercooking it personally, but I think that it is true that we're only just starting to see people kind of getting into it or getting the message. Like a lot of people don't even realize that the price of Bitcoin is in high 60s or low 70s at the time of recording. I think it's 67,000. A lot of people don't realize that, and they might not even realize yet that you can access it using exchange traded funds on their share trading platform that they normally use. So that's massive when that eventually catches on and we keep on going past new all-time highs. But it's hard from where I sit anyway, just to get a feel for what these institutional flows look like. I know that they're big. I know that they're coming. But do you, Rupert, have a handle on what we would be looking at in terms of activity here, like in terms of increase?
Yeah, I mean it's pretty amazing, right? So I'm just got in front of me the BlackRock, the iShares product, which is by far and away the largest.
Yeah,
I mean they've taken net inflows of $8.5 billion in the last month. I mean that is absolutely massive. I mean Fidelity. Again, is another massive kind of buyer of these of this asset. So hold one sec.
And I guess as you're doing that, there's another thing that's going on, which is like the funds in Canada and some of the European funds. They're seeing a lot of outflows happening as well, because effectively there's a race to zero going on with a lot of these fund providers in the US, right?
There is, but I think, and that's where it's kind of interesting, right? So everyone's saying, oh, but a lot of it's kind of moving money from existing funds or existing products. But say that they've only been able to track about $1 billion worth of outflow from existing products. And then where we've got BlackRock alone have managed to deliver $8 billion. And I think Fidelity's up in that, my number's not coming up, but they're up in that 4 or 5 billion already as well. And so I think it's pretty clear that we are seeing these massive inflows happening. We're seeing that's clearly driving the Bitcoin price. And even when you look at the intraday trading patterns, you can see how closely related they are to those ETFs. And so it's kind of been an interesting mode, right? I mean, even the BlackRock fund, they've had inflows year to date of $12 billion since they've launched. And so, I think it really does show at this size, at this scale, the providers will be sitting there going, this is awesome. This is clearly doing what we hoped it would do. And I suspect the institutional investors haven't even got into it yet.
Yeah,
I think this is the first wave of retail.
Yeah.
And I suspect the institutions are just waiting to see where it all lands, trying to figure out the patterns. And the beauty about it is hopefully we're about to see a whole lot of the algorithmic funds, the quant farms, all of those guys who will start to come in and start trading the volatility.
Yeah. Like I was talking to one manager here in New Zealand just around, hey, when will this fund actually be available on your platform? And it was the first time I asked them, it was, I don't know. And then the second time I asked them 2 weeks ago, it was, hey, maybe towards the end of this month, check in with us again. So things are obviously happening, wheels are in motion, and it will take time for things to come online for a lot more money. But more people are talking about it. More people are thinking about it. It's just a matter of, the question will be, well, how much should it be in terms of the overall allocation within my own portfolio? Not should I, it's how much should I?
Yeah.
And that's a significant change, isn't it?
And then I guess the other big question, right, is then you've got to turn around and you ask yourself the question of how big though? And that's the bit that I can't quite get my head around.
Yeah.
I mean, yeah, so if we sit there and we go, look, between the two biggest ETFs, there's probably close to $25 billion in those already.
Mm-hmm.
Do we think they become $100 billion ETFs? Are they $200 billion ETFs?
Mm-hmm.
I just don't know. And the problem that we do have with this as a product is it's very much momentum driven, and also with tight liquidity available in the market, which, yeah, that is one thing that does give me a little bit of a pause for concern.
Mm-hmm.
Is we do know we've got a wave of buying right now. Does that keep going? And what happens when the demand, that initial surge of demand, dies down? And that's why I kind of go, that's why my point around a lot of the institutional stuff and a lot of the quantitative guys, that's what I suspect they are waiting for as well.
Sure.
And that might be the answer to my question, is that, well, it's probably my hopeful answer to my question, is that there is a wave of the second tier, which is likely to be the more sophisticated investors who will come in second. Yeah. I don't think they are there yet.
Right. They're looking for tighter liquidity conditions. Is that what you're implying?
Well, I'm saying the institutions would have been sitting there going, cool, let's figure out, let's see what the trading patterns are. Let's see how this trades. Let's see how it goes. Let's kind of make sure that they're going to be there for the next kind of 6 months, 12 months. There might be some changes in documentation that have been needed. We saw last week, BlackRock have kind of now changed some of their documentation to allow inclusion in their strategic asset allocation funds. So there'll be a bit of that stuff that's happening. But I don't think the institutions are there yet. It'll be interesting to see when they get there. But it could be a little bit of time before they get there.
What are your thoughts, though, around just general price action, not in terms of where it will go, but just the level of volatility or price change within a short period of time? Part of me thinks that the more active participants there are, especially when you start getting passive inflows coming in, you're probably going to get a lot more steady buying pressure, which might hopefully reduce the volatility. But at the other time, I don't know enough about what these other people are who are now investing in Bitcoin, and maybe they haven't gone through the gut-wrenching market pullbacks yet that anybody who's been into crypto for a while understands. And maybe they might drop their bags really quickly as well when they see the first sign of trouble. And then we have another problem on the other end.
And we know they will, right? There's no question, and that's a little bit of my concern. We know that when they do become nervous on it, that they are likely to sell. Unfortunately, it is a trend product. The flip side of it, though, is we also know the cyclicality of the asset class, right? Do these ETFs, and is there now enough in the market that people go, okay, cool, I can now be confident that this thing is not going to zero? And the moment the narrative in the traditional finance land turns to that, it's all about when do you go, right? And so that's what I find the most interesting set of questions. It's going to be, my personal view is we will get a pullback at some point. Retail will get scared, but then I think the institutional investors will step in at that point in time. And hopefully once they're in, they'll stay. And that's what deals with the volatility, right? Because the beauty about having quantitative or arbitrage funds that are sitting in there, they're just going to be sitting there constantly kind of trying to buy the dips. They'll be holding for 5 minutes, 10 minutes, however long the time is. But this is what you see in the stock market. And that's the beauty about where we're going now, is we're also going to start to see that in crypto land as people start to trade these ETFs. There's a massive question. Can the ETFs handle that? We have seen a little bit of dislocation at times between the ETF and what we're seeing around the close in New York when people are going and buying products. But yeah, it's a really interesting kind of dynamic, and I think it will lead to a much more sophisticated market.
Yeah. I don't know if you've been following the news just around what Coinbase has been up to when there's been significant price spikes of Bitcoin, but there definitely is a strong allegation, or and maybe there's a good amount of truth to this as well, that they effectively, Coinbase, are acting as a bit of a circuit breaker when there is incredibly high demand. Everything just gets shut down, and you just can't access Coinbase in terms of accessing,
Really?
but making your own buy orders as a retail investor. And the theory goes is that, yep, the gate is still open, or they're keeping some time for the big guys. But now, if it's you, just get in the back of the queue. Have you heard that, or is that something that,
I haven't heard that.
yeah.
Would that surprise me? No. I mean, to be honest, that's what happens in every other financial market. So why would crypto be any different? Like, I mean, come on, you've got the institutional guys that are buying hundreds of millions a day. I mean, the average daily volume and inflows on the Fidelity product is $350 million a day. The average inflows at the moment on the Bitcoin, on the iShares product, is $464 million a day.
Yeah.
I mean,
The
let's be honest.
temptation's there.
Of course, you're going to look after those clients ahead of the others.
Yeah. Yeah. Interesting, isn't it? All right. Well, on that conspiracy theory bombshell, we'll leave it there. We covered a lot of ground today, though, right?
We did.
Yeah, I'm surprised after we finally got our A into G. So we'll catch up next week, and we'll explore maybe some of these threads a little bit in more detail. But I'm sure there'll be more news for us to explore by then.
There will be. I reckon next week we'll be talking about mortgages and GDP with everyone. The next 3 days of commentary around what GDP is going to do to your mortgage. So it'll be a fascinating conversation. I'd just ignore it if I were you.
Okay, cool. Or let's just talk about it next week.
Exactly.
Awesome. All right, good one, Rupert. Enjoy your day.
Thanks, Darcy. We'll speak next week.
All right,
Bye.
see you.